Good day everyone and welcome back to another trading tutorial from Market Geeks. I'm Roger Scott and today I'm going to teach you the 2x inside day strategy. Before I begin, I'd like to remind you to subscribe to our video channel and don't forget to visit marketgeeks.com for your free trading report. One thought that many traders consistently obsess over is how to create simple trading strategies that offer the lowest risk and the highest reward. I can relate to this because I used to go through this type of thought process myself several years ago. I always thought about ways to minimize my risk and increase my profit potential, and it's not something that's always easy to do. One day, by pure chance, I stumbled on a trading pattern that allowed me to enter the market with very low risk while maintaining the ability to profit substantially. What I liked best about this method was the strong momentum that follows after the entry signal is triggered. This strategy works with stocks, futures, commodities, and Forex, in case you trade any of those markets. The strategy is very easy to find on an open high-low close chart, and I'm sure after this tutorial you'll have no problem finding several examples yourself. The first thing you need is a strong trend going either up or down. Anyone who follows my tutorials or enrolls in the courses knows I'm a big proponent of going with the current market trend. You can see in this example how the stock is trending strongly. You want to make sure you find good trending markets so that your odds of avoiding getting stopped out are substantially decreased and your profit potential is substantially increased. Once you identify the trend, you have to identify the actual setup. The 2x inside day is a cone-shaped pattern that has two inside days inside of each other. I developed this setup to find days within a trend when the market slows down substantially and takes a breather from volatility. This offers me the opportunity to enter during a quiet period before volatility picks up once again. I also consider the fact that no lower lows were made and price action was able to maintain inside the previous low. This demonstrates continued strength may be ahead. You can see in this example how each day's high and low are inside the previous day's trading range. This is the type of setup you want to find when trading the 2x inside day setup. You can get a closer look of this pattern from this example. Notice how each succeeding day is inside the previous one. The trading action gets very tight, which lowers your risk substantially when you enter setups with low volatility such as this one. The entry is 5 cents above the price high that was made on day 3, and your stop loss level is between 10 and 15 cents below the third day's low price. The entry signal must be triggered on the 4th day. If the buy stop does not get triggered on the 4th day, you must cancel your order and the trade is nullified. Once the entry stop is triggered, you should always immediately place a stop loss order below day 3 low. The profit target for this strategy is set to 4 times your risk level. In this particular case, the risk was only 55 cents. So the profit target would be $2.20 added to your entry price. You can see the entire sequence from the entry to exit in this example. Trades with risk of less than $1 that have 4 times profit potential are considered very low risk trading opportunities. This is what the 2x inside day strategy offers. The 2x strategy works equally well to the downside as it does to the upside. You can see in this example how the stock broke the uptrend and is developing a good downtrend. This is a good example of the type of trading action you want to see before the trade sets up. The beginning of a trend is a great place to enter because momentum usually increases as trends continue moving in the same direction. Once you establish that the stock or other market that you're trading is in a downtrend, you need to isolate the setup. In this case, you would once again look for 2 days that are below the high price of the previous day and above the low price of the previous day. Once you see the setup a few times, you will start noticing it over and over again when you scan charts for your daily hit list. You can see in this example exactly what the setup looks like. Once you identify and isolate the setup, you can place your sell stop entry order 5 cents below the low made on day 3. And once you get filled, place your stop loss, which is your buy stop order, 10 to 15 cents above the high that was reached on day 3. This example demonstrates exactly where the protective stop loss and the entry sell stop levels go. You can see the entire sequence on a daily chart, which may give you a slightly different perspective on the setup and the entire trade sequence. The key to this strategy is isolating patterns where your risk is extremely limited, such as these 2 examples I provided for you today. The risk for each of these 2 examples was less than $1. This is a great risk for a trade that can yield anywhere from $2 to $4 in profits. That's it for today's tutorial. Please don't forget to visit MarketGeeks.com for your free trading report. And don't forget to subscribe to our channel for trading videos and trading tips. This is Roger Scott wishing you the best in your trading.